Nice to see everybody this morning. We're going to dive into the public information call around the Vermont Community Foundation investment performance. The purpose of, just as a quick reminder and orientation, there's some folks who are here and regularly on these calls and some folks who are participating for the first time. The intention is really to give everybody, fund holders who are interested, a chance to have a better look at quarterly performance and of the VCF's investment holdings. We're joined by Mike Miller of Crucial, our advisors from in New York, who will talk about our long-term pools performance, the socially responsible pools performance, and the midterm pools performance. We've also asked Lawrence Miller to join us. Lawrence, for the last year or so, has been serving as a senior advisor for Mission Investments, responsible for organizing the Vermont Mission Investment portfolio. And every fund of the VCF has a 5% asset allocation to community investments to advance our mission of economic and community vitality in Vermont. Lawrence has done a wonderful job over the course of the last year, organizing that portfolio, updating the investment policy, and helping us effectuate that strategy. So Lawrence is going to take a few minutes and give us an update on that pool and some of its activities. So when you're driving through St. Johnsbury, Bennington, St. Albans, any number of places, you can understand how your philanthropic capital is actually actively at work in those communities, in addition to the grant making that it effectuates. I also want to, I don't know if he's kept his screen on. There he is. I want to point out a new director on the VCF board of directors, Tim Briglin. Tim has also stepped in as our chair, as the chair of the investment committee. So in terms of our structure for investment decision making, Crucial works with our investment committee to identify asset allocation strategies and identify managers, and the investment committee makes decisions around those investment managers. I serve on the investment committee ex officio along with the treasurer of the board, and Tim is chair of that. His background is as a partner in Tuckerman Capital, a private equity firm based in the Upper Valley, and a former legislator and a longtime active community member. So thank you for taking on the chairpersonship of the investment committee. So with that, I'm excited to dive in and I'll turn it over to Mike Miller just to walk through our performance. We'll spend 30 or 40 minutes on the performance of those pools, and then we'll turn it over to Lawrence for an update on the Vermont pool. Sound good?
Thanks, Dan. Good morning, everyone. Nice to see you. I'm going to share my screen. I believe you all should have received, make sure I can do this right, hopefully. Hit the share button. You should have all received, let me make this bigger on my screen, sorry. These slides in advance, I believe, hopefully, but these are sort of nothing surprising here. And like Dan said, I'm going to spend a bit of time on the performance of the pools, which continues to be quite good. And we'll talk through some of the reasons for that, because obviously you don't need me to say that the world has become increasingly complicated. It feels like every quarter something new gets added to the list of complexities and nothing gets removed from the list. So that list is getting very, very long. And this is a challenging time for many people on many levels. And so I'm going to keep my remarks, of course, very focused on capital markets and economic conditions, because that's our wheelhouse. So you can see here the snapshot of returns over time. With long-term pool, you can see up 5.1% year to date. I am glad to tell you that it's now up through last night, close to 8% year to date. So and it's also ahead of its benchmark again, which is good to see. It had a double-digit return for the last year, which is nice. And the losses of 2022, which they're still in there, of course, seem to have disappeared. And this is part of the philosophy of long-term investing. We did have a rough 5-year period, as you can see. And that was obviously disappointing. A lot of that was around our value bias and some of the things that we continue to do, by the way, which are not hurting as much more recently, which is nice to see. That's the 3 years of 3-year outperformance number. You see, we haven't changed anything, just to be clear. And then 10 years, we've matched the benchmark. 15 years, we're 1% above. 20 years, we're 1% per year above. And if you look at those 15 and 20 year periods, one of the things you'll note is that the toughest number on this page is CPI plus 5%. This has been a really, really rough time. The custom benchmark and the average endowment foundation are about the same number over those periods of time. So the pain of being underneath that number for such a long period is quite significant. We too are under it, but we're a lot closer at 0.6% per year in the long-term pool and 1%, it's 0.7% per year, excuse me, in the for the 20 years, excuse me. So 15 is 0.6, 0.7 for 20. That we're still in the game. We can catch that up real fast, and you can almost see a little bit of it happening for the last year and year to date now again. Even though you can't see it here, you'll see it next time I see you, I think. The good news is that we can catch up. As you fall further and further behind, it gets really tough. And the bad news, and we'll talk about this a little bit later, is that kind of the commoditized investing that's taken over the world isn't going to get you there. It hasn't worked in the past, and it won't work in the future. So this is one of the reasons that the Vermont Community Foundation, and it's great to have Tim on board as the investment committee chair, because we have a really savvy investment committee that is doing things that are not run of the mill. And those things span a lot of different areas. And it's one of the reasons that the portfolios, the outcomes, and the mission of the foundation are also closely linked to one another. So I'm going to jump in. Oh, excuse me, before I jump in, the socially responsible pool right underneath. So this pool has been actually the winning pool, the stellar pool, particularly over the last year. It's actually also up now about 8 or a little over 8% year to date. So these numbers are also, we're feeling pretty good about that. We would love to have a high single digits, low teens return for 2023. That would feel great. We'll see what happens, of course. But you see for the year up 15%. It's had better returns, and then the long-term pool all the way out to 10 years, 15 years, a slight deficit still. And each of these pools has their own idiosyncrasies. For example, social responsible pool has more bonds, a little bit more growth stocks, and some of those things have actually been both helpful and hurtful, depending on when you look. And so both pools just have really great return drivers, which is why you see them both, generally speaking, especially if you go to the longer periods, outperforming their benchmarks. They're both very capable of it. There is no trade-off in terms of long-term versus socially responsible. Either way, they both have their moments in the sun, so to speak.
Mike,
and the last moment, yes, sir.
Sorry, I hate to interrupt, but if I see
Please
a question pop up, I'm going to jump in. But Betsy Walkerman had a quick question about if you want to finish the slide and then give some. I want to make sure you saw it. Give it some context for the custom benchmark and how Crucial's generated that.
Thank you, Betsy. I usually say that, and I'm on a time clock today, so I'm rushing too much. So let me not rush past things that are really important. So the custom benchmarks. What those do is they take the asset allocation strategy of each pool at each moment in time. So that can be the investment committee reviews the strategic mix of the pool once a year. They don't change it every year, but they can change it. And when they do change it, we reflect that. But then what it does is it takes those weights, and I think I'm going to show you that. I'm not going to show you this thing. It takes those weights and assigns a market index to each piece. So the S&P 500 for large cap stocks, the Bloomberg aggregate for bonds. And so it's essentially what would we earn if we just used index funds and the same asset mix the committee and the board and Dan have adopted over time. That's how we calculate that number. So it's really important because we are paying fees to Crucial. We're paying fees to investment managers. And the returns you see, just to be clear, are net of all those fees. So when I say, hey, look at the 15 years and 6.7 versus 5.8. 5.8 is what the index would have given us. Yes. Oh, did I jump in? Someone trying to pause? Get me in? Sorry. We okay? Okay. Oh, I thought I heard a voice. I'm sorry. So the 6.7 is what the Vermont Community Foundation portfolio actually earned after paying all the fees. And 5.8 is what it would have earned if it had just been an indexes with the same asset base. So that's what the custom benchmark is. Forgive me. And what you can also see, which is a kind of a proof point around this, is you look at the bottom, which is the midterm pool, which has more bonds. And so it's for funds with a shorter horizon, i.e. we expect quicker and faster pay down and bigger grant making out of the funds. So it's more conservatively allocated to bonds, for example. There's a lot more in bonds than the other pools do. And in that particular case, you can see it's actually right on top of the indexes. And there's a reason for that, which is it's invested in the indexes. So we want to keep that very liquid, very simple. And that's been a very effective strategy in the sense that it's something exactly what you'd expect it to do. That's the beauty of index fund investing. You do get the returns of the index. So I'm going to keep moving along unless there are other questions. Yes, so it's based on it is based on a mix of index funds, Betsy. That's exactly right. So this graph takes the long-term pool's outcomes compared to the benchmark I just showed you a minute ago and tries to put them in some context. Because one of the things that, Dan referred to this earlier, while we are big fans of short-term outperformance. It makes everybody feel good. I know I feel like my job's a little more secure, and that's all good stuff. But the reality is that it's really not that important. We need to stay focused on long-term outcomes. And when we can compound capital at higher rates of return than the indexes over long periods of time, that's the thing that really matters. And so every decision we make isn't driven by, well, what's going to help me in this year? We have a bunch of stuff in this portfolio right now, which actually I don't have any expectations going to help us this year. We have expectations that 3 to 5 years from now, there are things that are worth 5, 10, 15 times the current price. But a lot of things have to happen to make that occur, of course, but we have no expectation of a short-term reward. And the reason we feel this way is what you can see on this graph. So we went back to here for a second. That 11.9 is a super impressive number, or the 15.1 for the SR pool. Here, this is just the long-term pool, just to be clear, so we have a longer record for it. And here, that 11.9 doesn't really look that important now, does it anymore? And the difference between this graph and the one you saw before is that this is cumulative returns. Those were per year, so we annualize them. And so the cumulative, which is the compound return, is a big deal. So let me just take you back one more time. So 6.7, 5.8, 6.9, 5.9, those are nice premiums, but so what? But then you see it this way, which is 164% versus 133%, or 280% return versus 214% return. And this is what we're here to do. And this is the time horizon we think about. And the other thing we want to do is we don't like these 5-year outcomes. You can see here the 18.2 versus the 25.8. But we will, if we have to, and we don't have to, so we have to make some different choices sometimes, we will trade those two. So if you can tell me, hey, you're going to look kind of silly for 5 years. You're going to be only up 18 and the index is up 25. But over 20 years, you're going to be up 280 versus 214. I know I would take that. That's okay. It's not perfect, but it's okay. So while we're on the subject of outcomes, the best way to look at outcomes is what we call a rolling period analysis. So what that means is, so when I show you these returns on these quarterly calls, one of the problems with these is they're just a snapshot in time. So at this moment in time, this is what it looked like. And this is, by the way, the thing that really gets investors in trouble, because they see a 5-year return that's bad and they say, oh, this is no good. They see a 5-year return that's good and they say, oh, this is brilliant. But what they fail to see is, well, how often is that 5-year return good or bad? Like, you need to get multiple data points. Anyone who ever did, I'm sorry, I have a master's degree in statistics. So I think this way, but anyone who's ever studied statistics knows that you don't look at one point of data. You look at as many as you can. And what this chart we're showing here is doing is it's taking the socially responsible pool's returns from 2010, when it was started, till now. It's looking at every single rolling 3-year, 5-year, 7-year, 10-year period there was. How did this pool do compared to the benchmark? So I showed you earlier that it's outperforming over many of these periods, but that's just now. But let's go back and look at every single one of these periods. And what you see, which is really interesting, is take a look at the batting average. So every 3-year period, I'm rounding up, 72% of the time it outperformed. Every 5-year period, 79% it outperformed. And then 7 and 10 years, and this gets back to what I said earlier, that we make decisions with long-term outcomes in mind, 90% plus. So that means, if you think about it this way, 9 out of 10 times you get on a call with Mike Miller and you see, or whoever, and you see a 7 or a 10-year return that beats the benchmark from this pool. That's really, 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 really important. Because while we are willing to have some short-term underperformance in exchange for great long-term outcomes, we're not willing to make this a 50-50 proposition. It needs to be something that inspires confidence, and 90% success rates inspire confidence. Now, the second thing that you want to ask yourself is it worth it? Because outperforming a benchmark by, 0.1% per year after fees. So, why bother? I mean, why are we paying the fees to get a very, very mediocre outcome? But take a look at this. So the median outcome, which is the second line, shows you how the portfolios, how much did it outperform by? Now, the numbers get bigger across the page for a simple reason. These are not per year. They're the cumulative levels of outperformance. So we would argue that, hey, look at that 6% level of outperformance. That's worth it. 6% on, $1 million is a lot of money. 6% on $100 million is even more money, of course. And that's value add in the hands of the Vermont Community Foundation and its impact in philanthropy. So it's got real significance. And then the last thing we look at is the skew. Because the other thing you don't want to do is you don't want to have feast or famine. You want to have a positive skew. Now, you can see for 3 years, we actually don't. The worst outcome we had was worse than our best outcome. So we're not too happy about that. And that's something that we're going to have to, continue to evolve and get better at what we do. But for the longer periods, particularly 7 and 10 years, you get something much closer to what we're looking for, which is, the worst case scenario for 10 years was we were 4.8% behind cumulatively, not per year again. The best case is we were about 10% above. So again, we like that positive skew that you see here. So the next slide I'm going to show you is just for the long-term pool. And I want to highlight something before I show it to you. The big difference between that pool and this pool, the socially responsible pool, has a much heavier index component to it today. And so that dampens these outcomes a little bit. So the long-term pool in some ways is going to look better, you'll see. But it's interesting to think about if you could marry somehow the index and the active and all these things together, what that might look like someday. Time will tell. So this pool goes back longer. So to 2002, when we started with the foundation. Oh my God, I feel like I started when I was 12. And you can see at the top line is, again, what are those batting averages? And here, extremely good. We're very happy with 80s. I hate numbers like the last one, believe it or not, 100% success rate, because it only has one place to go. Hasn't happened yet. Someday it will, I hate to say. You can't avoid it forever. But then what you can see is the median outcomes. These are really big outcomes. Think about 30 percentage points of outperformance, on hundreds of millions of dollars. That's gigantic outperformance. And when, folks want to be in the index, one of the arguments, no one on the committee does, of course, for this reason, one of the arguments is, hey, we would have lost 30 percentage points of return on a median basis over the last 20 some odd years. And so that's not to be trifled with. And then you can also see these skews. 3-year, just like in the SR pool, it's a little bit better here, but it's not great. It's almost 50-50. But then you get to 5 years, 7 years where the skew is 25% of outperformance and only 2.7% underperformance. So that's like exactly what we're looking for. And 10 years, there is no worst outcome below zero because of 100% success rate. So this is really important in terms of, you have license, I think, to do things that are a little different, but they have to work. And so, yeah, Betsy, another good question. Thank you. Is the tenure is cumulative. So again, these are not per year. That's why these numbers get bigger. And that's why they should get bigger as you go through the longer periods of time. If you're outperforming, more time does compound that outperformance. So again, this is a really significant part of how the Vermont Community Foundation's success has occurred. And what I'm happy to say is because it's not, hey, here's the moment that we're doing really well. Here's one of many moments that we've been doing really well. I really think that's very significant. Now, we can spend all day talking about batting averages and skew and all these things. But at the end of the day, this really comes down to dollars. What dollars are available? And that's why that CPI plus 5 challenge, and it's become a big challenge, is something I will tell you consumes my thoughts, because we need to get better. We need to beat that number. We're close, but we're not there. And that's a real problem. And if you think about all the success and you're still not there, that shows you how high the bar is, which is why I'm mystified, I will admit, by the commoditized investing going on again by nonprofits, at least, because I don't understand how they think they're going to ever get near CPI plus 5 with that here in La La Land. So with that said, what we want to also show you is the way philanthropy and the importance of philanthropy in the here and now and in the future all balance out. So what we did is we took $1 million fund, and the fund's hypothetical, the returns are real, and we invested it in the Vermont Community Foundation's long-term pool at the beginning of the relationship with Crucial in 2002. And then all we did is we took out 5% a year of a 20-quarter rolling average. We never added another nickel to the fund, to be clear. And we said, okay, let's see what happens. And then we invested that portfolio in one of 3 options. The long-term pool, which are the blue bars you see here. The orange bars are 60% global stocks, 40% bonds. And the gray bars are just global stocks, which is increasingly the Magnificent Seven these days, which fascinates me too. So fund balance change. So if you look at the bottom, so the fund balance changes, you had $1 million when you started. Now you have more than $1 million after all the spending. Now, what you can see, someone's closing a window next to me. So what you can see above that is that actually we would have been better off if we just put all the money in the stock market, because that gray bar is above the blue bar on the left side of that page. But now look at the middle. Again, remember the balance change isn't just the return; it's also what you took out. So you can see the blue bar in the middle is actually quite a bit higher than the other bars. So we actually had a bigger philanthropic impact, without question, over that period of time. And that's interesting. And then the last thing, which is a completely made up term, I don't know if Dan would even bless it, but it's a crucial term, total philanthropic impact, which means how much did we grow your dollars versus what did we spend, plus what we spent. So you can see that's why the higher spending actually pushes the blue bar back above the gray bar, and they're both trouncing the orange bar. So again, this is all in all a very good outcome. We would like the perfect outcome because we're really kind of persnickety that way, and we want everything to be as good as it can be. So I want to see that blue bar above the gray bar. I think we'll get back to that. But there's more to this story. So just this simple addition is fine, except this is the same problem I was mentioning before with returns when you look at them at one moment in time. Now, this is 21 years. So what? I mean, essentially, yeah, great. But what does that feel like over the 21 years? Nobody ever says, hey, I'm going to do something in 21 years from now. I'll see how it turned out. So this this graph takes those middle bars that we showed you, the spending, and looks at basically the pattern of distributions and grant making over time. So the blue line, again, is the VCF's long-term pools, what was spent each year. The gray bar is the All Country World Index, again, all stocks, or the gray line, excuse me. And then the orange line is the 60-40 mix that you see there. And what's happening, of course, is really interesting. So you can see the first thing is that this gray bar has been on gray line, excuse me, has been on quite a wild ride. I mean, look at this gigantic drop from $65,000 in grant making to $47,000 in grant making. Clearly, I don't need to tell anyone on this call it's a nightmare. And it occurs over 3 or 4 years. And of course, that's a reaction to the great financial crisis. And the last thing in the world anybody needs during a crisis is to say, I'm sorry, we lost too much money in our portfolio. We're going to stop being stop our philanthropic or slow down our philanthropic activity. And that's the opposite of what needs to happen. Now, the blue line did drop too, you can see, but not nearly as much. And then we drew these little lines, which is the green and the red line. So that green line said basically, how long did it take to get back in this situation to where we started in terms of the peak. And now, of course, we've got nothing but kind of go up since then. And you can see that's a much shorter line than for the red line, which is what happened in the All Country World Index, where it took literally 12 years to get back to the peak. And it just recently crossed over and got better. Again, so that's not not a great strategy, it's a terrible strategy. So what I'm pointing to is that we need to think about not just the returns, we need that, must have that first, but we also think about how we get those returns. And it can't be, bet it all on NVIDIA. It's got to be something more thoughtful and that more balanced and that more diversified than that. And I know the investment committee, I think they agree with us, I know, but they get a little tired, so do I, of saying we're diversified or more diversified than this. And this is why that happens. Because diversification only feels good over long periods of time. It never feels good over short periods of time because you're by definition owning things that aren't doing as well as other things. That's the whole point. Oh, sorry. So, let's do this a different way. I'm sorry, guys. Make this a little bigger on the screen, maybe. So how do we do it? And I'll be quick here. The first is we think long term. So the investment committee's meeting today, unless Tim says otherwise, I'm pretty sure we're not going to discuss where interest rates will be at the end of the year. I'm pretty sure we're not going to have an opinion on what the S&P will do for the rest of the year, when the next recession will start, blah, blah, blah. We can go through the whole list of things that, everybody thinks is important and we agree, but we don't know. We can't make investment decisions based on stuff we don't know. We have to stay in the land of what we do know. So that's why we think long term. We don't change strategy based on near-term conditions. As I mentioned a minute ago, we diversify. Diversification is and I'll speak just for myself, but the ignorant man's answer to investing. If we knew what would do well in a short period of time, we would just do that. So these are the strategic mixes. So back to Betsy's question before, again, we assign an index to each piece of these charts. So large cap equity, 11%. S&P 500 is 11% of the index. For the SR pool, 19%. And you can see across the page. Here you can also see this is very well diversified. It's very global. I'm not going to have a lot of time today, but I'm going to quickly touch on something about why we're globally diversified in a minute. But you can also see the differences in these pools, where the long-term pool has a 5% hedge fund exposure and 12% in private assets. And this diversification has been a really important driver of the outcomes that you saw earlier. The committee actually recently did make some adjustments to this, so you'll be seeing that soon. But the adjustments are generally relatively small in nature because the committee doesn't swing the portfolio around. They revisit and think about this once a year. Get the question once a year, and they don't always change it. They did recently change it, so that will be updated as soon as we have this into the right time frame to do that. Quick question. There's a question about the Vermont investments, and I'm really glad that Lawrence is here because he's going to actually take it over.
Mike, I'll address that in the chat and see how Lawrence's conversation for you.
Perfect. Yeah, because definitely not my area of expertise, although it's a wonderful part of the portfolio. I can say that much. Okay, so I'm going to keep very quick here. I'm going to actually jump to this. Crucial's job, of course, has been to find managers over the years. You saw the outperformance over the long term. I think you will see outperformance again, just to be clear, if I can speculate a little bit there. And these are some of the rules we follow Crucial. I'm going to move right through this quickly. Here's some of the things that we look at. We do have a 17-person investment team at Crucial that does this work every day. I'm chief investment officer, so I'm also involved with them day to day on it. And it's just, it's what we love to do, of course. And it's a hard job sometimes, but it's also a fascinating job. So the quick thing I want to leave you with as I get to my last 5 or 10 minutes with you guys on this, is just a little bit about this climate we're living in, because, this is one of the most fascinating climates I think we've seen in a long time. And I will admit, it's It's not a bad climate for an investor if you're an investor. It's a terrible climate if you don't know investing rules because the temptations out there are just awful. So let's just take you through this quickly. First point. We saw, obviously, I'm only short term, but yesterday, the world suddenly decided there's no inflation problem. I think, unfortunately, that's not true. Inflation is a real problem in our country and around the world at this point. And there's all kinds of reasons structurally, while it's likely not to be crazy high, but higher than we've been seeing since the great financial crisis. And higher inflation is seriously, it's almost like, it's like kryptonite for markets in the sense that it leads to some real serious problems. One of which is that the Federal Reserve and other central banks around the world now can no longer just throw money at every problem because there's inflation implications they have to worry about. That's what you're seeing right now. And I think the thing that's going to really, really frustrate people is when the economy does turn down at some point and the Fed doesn't ride in with $1 trillion of new bond purchases. They just really can't do that unless they succumb to the political pressure. So we can't rule it out, but I don't think it's likely. So higher cost, which means rates are higher, and competition for capital. And think about it in your own lives. Right now, you can put your money in a T-bill or a money market fund and get a really pretty nice return. That's competition for capital. It's very core. It's basically that you have choices, and everybody has choices. And that's not good if you need capital and people don't want to provide it to you and they don't have to anymore. So capital scarcity, which is what we refer to, we call that's game changing. And people don't appreciate, and this is where no one likes to hang out with me too long. This has serious implications for bankruptcies, for all kinds of dislocations in markets and companies. And frankly, you can't just fund kind of stupid pipe dream type ideas anymore. You have to do solid, reasonable, smart things to get people to give you capital. Even when you're doing solid, reasonable, smart things, and people won't give you capital. So it's really, really important. And then again, I'm sorry, one more screed about the S&P. We find it fascinating at a time where most people would agree with the statement that the world feels riskier on a lot of different levels right now. The indexes get more concentrated, and we get the genesis of the idea, which is Apple's such a safe business, Amazon's such a safe business. They're so dominant. I will, of course, not resist. I will not resist the temptation to say people said the same thing about Cisco and IBM and Kodak and all kinds of names in the past. So I don't know why this generation thinks it's different now, but putting that aside, the indexes are more concentrated than they've ever been. And one of the things that you learn as an investor really fast, if you don't learn it fast, you're going to have a problem later. Concentration and risk are synonyms. So the idea that more concentration is good in a complex time is inanely silly. But that's where the world is today. And it fascinates us to no end that that's where people are. Again, we understand why they are the way they are. But the point is that this risk is a real issue. So the really quick thing I want to show you in my 5 or so minutes left is this. Just 4 basic rules of investing that you should follow everywhere. Rule 1, markets are on a random walk. I know people hate that, but we don't know what markets are in the short term. And actually nobody does. And people who make predictions, no offense to those who do it, are just playing lottery tickets. They have no idea. They can't. It's just it's impossible to know. And then 3, again, this is why my wife likes mom on the road more than at home. Popularity is not your friend. Despair is. You could see how much fun that must be to hang out with people who think that. But that's true. So when you make an investment, I know when we make investments and everybody thinks it's a great idea, I get super nervous. That's a big problem. When people hate our idea, it doesn't mean it's good, but it's got a better chance of success. So despair, things people don't want to do, is where you find the best opportunities. And that's because human nature is really simple. People tend to overprice easy, good stories and underprice bad, complicated stories. So we're very focused on that. And then the last thing I want to show you is the cyclicality. So a lot of the current concentration, it's not just that the S&P is concentrated, that people are concentrated in U.S. markets. So these next 2 graphs briefly show you the cycles that have occurred over time. So the EFA index are non-U.S. stocks, Europe and Japan. How have they done on a rolling 5-year period since the beginning of EFA in 1970 to today? And you can see, first of all, there are cycles. But if you look at the far right, which is that dark blue area, the S&P has been on top, been beating in EFA quite handily for a long time now. And this is where the behavioral trap, because we all suffer from a behavioral flaw from an investment perspective called recency bias, where we assume whatever has been happening to us in the recent past will continue. It's been studied by psychologists at William Ways from Sundown. It's a thing. And it's a really bad thing in investing, because if you think that what's ever happening will continue to happen and there's actually cycles, well, then you're going to be on the wrong side at the wrong time of when the turn does come. Turn hasn't come yet, but it's a long period of time. This graph is the same thing, but for emerging markets. So think China, India, used to think about Russia, but now we don't. Brazil, Central and Eastern Europe, et cetera. Same story. Cycles, yes. long period of dominance on the right for the S&P. So what we then did, and this is, I won't take too much time on this. I hope I get another chance, another call to talk about this more. We still are globally diversified. Now, one of the things I didn't mention, which I want to mention briefly now on those other two slides, is it gets even worse for someone like me who's telling you to stay globally diversified because of cycles, which is that if you measure each of those indexes, EFA and the emerging markets versus the S&P from the inception of those indexes, so 54 years ago for EFA, 53, and 34 years ago for emerging markets, excuse me, S&P's beaten both those indexes by about 2% per year. And that's like, wow. I mean, that's like, think about it, 50 years. I was showing you the power of compounding before with a 1% spread. Do it for 54 years at a 2% spread. It's enormous. So, however, the problem with that theory is, first of all, that could unwind because there's an endpoint again of that data that I just gave you. Like the endpoint's now, we just saw this dominance. But forget that. Pretend that doesn't matter. Instead, let's do something else. Let's just create a balanced portfolio, and then let's also do some rebalancing with a little bit of a contrarian tilt. So the really simple way to talk about this is as follows. We, in 1970, took 60% S&P, 40% EFA, and created a portfolio. We then changed that portfolio in 1988 when the emerging markets index came around. Again, this is all with indexes, 55 S&P, 35 EFA, 10 emerging markets. And then all we did, there's a footnote, so you can read later all the different pieces of this because I can't torture you all day with this. At the end of each year, we said, well, which index did best? Let's take 5% away from that if it's EFA or the S&P and 2.5% away from it if it's emerging markets and give it to whichever one did worse. So it's a classic contrarian rebalancing strategy, which, nobody wants to do because like right now, does anybody want to put their money in emerging markets? Probably not. But that's exactly what you probably should do based on history. So we created this, what we call globally contrarian portfolio, which again, those indexes I told you with the take from the best and give to the worst each year. At the end of each year, once a year, no funny business, no like, hey, maybe this year I'll do it, maybe this year I won't. You do it every year. Now look at the red line, which is that portfolio. These are the rolling 10-year returns from 1970 to the end of 2022. Now we didn't do 2023 yet because the year's not over yet, so that's why we haven't done it. The green line is the S&P, and something kind of jumps right out at you if you're like me, which is that red line is above the green, a shocking amount of time, given that I just had mentioned a minute ago, we put 40% plus of the money in the losers, EM and EFA over these periods of time. And we look at the footnote, we never went below a certain level. We didn't let this get to be 100% S&P ever. Now the one points to the right, you can see the S&P is ahead, but that's really interesting. So last point. What we then said to ourselves, that's really interesting. So now how about thinking about what I said earlier, which is that, every client we work with, the Vermont Community Foundation, life is a series of rolling 10-year periods. It's not just one. And we want to do well, need to do well in as many as possible, and particularly because capital and, philanthropic capital shows up at different points in time and leaves at different points in time. So, you can't just do well in 1992 and not continue to do well in 2002, 2012, whatever, et cetera, down the line. So what we did is we said, let's do this. CPI plus 5 is what we're here to do. And we will not achieve that if we can't get at least 9% on our public equities, because we're going to own some bonds, we're going to own some other things, and hopefully they won't hurt us too much, but they're part of that philanthropic balance I showed you earlier, not having giant drawdowns. So we have to do some things like that. So we need 9. Then all we did is we counted up the percentage of the time over this whole period of time, 1970 to 2022, the S&P actually achieved 9% or more. 64% of the time it did it. So that's pretty good. Then we did something which you hadn't heard about before, which is we added this static global diversified portfolio. And all that is that 60, 40, 55, 35, 10 without the contrarian part. So no take from the top and give to the bottom. And it did worse. Only 59% of the time it succeeded. So the S&P was better than that. Not really surprising given that the S&P outperformed the other two pieces by 2% per year. But look at the last line. This contrarian strategy actually did a lot better. I know it doesn't look like the biggest deal in the world, but 10% more success is game-changingly important. Like we must have that. We cannot pass on something, a free lunch like that one, particularly when we think the S&P is probably going to underperform by a lot going forward. But putting that aside, this is the evidence that proves why we need to do what we do. So the last thing, and I think I'm turning over to Lawrence. So the last thing I'll say is, thank you for your time today, of course. And I know I've been racing through at New York City speed here, but the strategy is really simple. We stick with things where we have a high probability of success. So when someone has an idea that feels like a short-term prediction, We, at least in our firm, we're not interested in it because we just don't think that we have any edge or ability to do that. Time is on our side. We use the advantages of scale. So bigger portfolios are better. Stability, which is, in this case, Vermont Community Foundation, I don't need to tell you guys, an amazing institution, amazing leadership, amazing investment committee and board, and that stability and that thoughtfulness. Man, I wish my whole job was like that. Unfortunately, that's not the way the rest of the world always works. And a long time horizon is super important. Despite my comments about the S&P, we actually do think index funds make a ton of sense. They make a ton of sense for most people, and they even make a ton of sense for part of this portfolio as well. Just you have to be very careful with it today. And then the last thing, and this is the part that I try to remind myself when things are just almost unbearably difficult out there for a variety of reasons, volatility, uncertainty, fear, all these things that, are part of the human existence, are really actually our friend. They tend to create amazing opportunities for investors, and that's one thing that we try to capitalize on. So thank you again. And Lawrence, I think the floor is yours. I appreciate everyone's attention.
You bet. And we will come back to Q&A. I'm only going to cover about 10 minutes of material, and we should have about 15 minutes for you all to ask questions of Mike or me or anybody else on the call. So the Vermont portfolio really started, it's around 2001. The VCF board made a decision to take 5% of the corpus and make it available for investing in Vermont directly in businesses and funds. And that's since grown to include other elements of the Vermont portfolio. So we have the Vermont Pool, which is that 5%. And then we have other investments in there, in funds and individual enterprises. And some of these have been gifts to VCF, for example, when the High Meadows Fund wound up. I think it's sort of important to recognize that this part of the portfolio is basically illiquid. There is no market for these securities, so they're not available for grant making, and the investment itself is the impact. It's not that it's producing revenue for grant making. And to that end, the way I think about this when I'm bringing something to the committee for consideration, I'm really thinking about alignment with the impact areas and the opportunity gap work that informs our grant making. So we're staying aligned with the areas of economic equity, affordable housing, education and training, climate and the environment, health and well-being, and democracy, trust, and community leadership. These are the areas where our grant making is focused for this current cycle. And so I think about this in much the same way, and coordinate with them. So we're looking at integrated capital opportunities for community and economic development, not just one-offs. I think it's worth noting as well, this is managed by a separate committee. The Vermont Portfolio Committee is separate from the investment committee. And that's really because it's a different type of work. The investment committee works with Mike on the asset allocation type of strategies that he's discussed. We have some of the same values in the portfolio committee, thinking about diversification as a key to success and risk mitigation. And we manage risk, but we think about it a little bit differently. We might not get paid a market rate for the risks we take if they are also fulfilling some of our impact goals. And we also look for situations where our investments in Vermont are playing a unique role where VCF's part of the capital continuum is making something possible that might not otherwise be possible in those areas. And I'll give you some examples. I guess another way I think about the return aspect of this part of the portfolio, if in the main pools we're looking at preserving purchasing power net of grants, expenses, and inflation, over here we're looking at preserving our purchasing power net of losses, expenses, and inflation. And so 2.6% annualized since inception. So basically a cash return. And the way we look at that is as a blended way. So we have some things in the Vermont portfolio that provide very nice gains, and those help support the things where we might have programmed losses because our return target is so low, or we're taking risk that we ought to be taking because nobody else will. And there's an important community impact from the work. I'll give you a few examples. We were the lead investor in the first Fresh Tracks fund. And one of the reasons that the board back at that time decided to take this step was because of challenges in access to capital for Vermont businesses. There weren't any funds in Vermont. So we've since participated in every Fresh Tracks fund, including the new one this year. But now we are also in the Flexible Capital Fund, the VCF Fund at Hula, the Corey Innovation Fund in Springfield, Features Capital in Norwich. We're going into Rural Works Impact Partners, and all of these are new sources that are supporting Vermont enterprises that just weren't there in the beginning. And it's VCF's participation in those early days that helped make it clear that there were opportunities, and our anchor investments in some of those funds helped them focus on Vermont and bring resources that wouldn't otherwise have been there. Another opportunity, we were the first investor in the Vermont Housing and Finance Agency's fund a few years ago, and we put a first commitment in of $1.5 million, and that's since grown to about $15 million. And that fund, in just a few years, has already facilitated 17 multifamily projects in 15 communities throughout Vermont. 80 of those units are specifically addressing the homelessness issue that we've got right now that's so critical. They'll have a ribbon cutting on the tunnel block in Rutland on December 11th, for example. That's preserving and renovating 13 units that might not have stayed in permanent affordability and adding 3, and that's right downtown, near services, near grocery stores, near transportation, right where we need it. And we're supporting those types of projects in communities throughout the state. And it's really neat to work with partners like that. And we can put that type of patient capital in at a very low return rate because we're getting that impact that we're looking for, and we're supporting it with those other higher yield investments. And Rutland's a good example of a community that we are looking at that integrated capital approach and other efforts in supporting a whole community change. We have recently made a commitment to start up Rutland, which is an accelerator program in Rutland, and they're building a local fund to invest in Rutland County businesses, and their accelerator is trying to attract businesses to Rutland from away. And so these are all pieces that work together. We supported the Corey Fund that did some work in Rutland. I would say 20 years ago, I would not have thought that Rutland would be ready for this, right? And now it is. And it's because of the leadership of local community members, but also diverse statewide support coming in and supporting the initiatives that those local leaders are supporting. And it's just really neat to watch how that arc happens in places like St. Johnsbury, St. Albans, Springfield, Rutland. In some respects, Chittenden County can kind of take care of itself. We look at other parts of the state and really think about what are the anchor institutions that a community needs to survive, and how can we help support those. And I'll lastly close with one other example and then turn it over to Dan for Q&A. We put this one in the most recently quarterly report. Example is the Yellow Barn project up in Hardwick. And so this is a really challenging redevelopment project connected to the food and farm ecosystem that is in Hardwick. Cabot, Jasper Hill cheese, some incubator space, Center for an Ag Economy, all of this in sort of a very challenging programmatic redevelopment, but also a new market tax credits supported financing package, which is incredibly complicated. So we're able to put very cheap money in there and just leave it while they worked through all of these complexities. And now that they've completed that closing, we're redeeming through the construction period. We'll get all of our capital back by February, and we'll be able to go out and do it again with another project in another community. So that's the type of thing we're up to in the Vermont portfolio. Dan?
Thanks, Lawrence, for running through that. Happy to open it up for questions for either Mark Lawrence or or myself if there are questions percolating on the call. I just ask if you are going to ask a question, come off screen so we can make eye contact, or come on video. There you go. Any questions? The state of the world globally, state of the world nationally, the state of the world starting in Rutland and outward. Come on, I leaned on Mike to be brief so we have room for Q&A. Well, I'm going to keep going on what Lawrence was talking about. I want to, and I'll use the Rutland example, and then there's another example. The idea of integrated capital is essentially the ways both philanthropic grant making can and mission investment can complement each other. And what started probably 4 years ago as some grant making from the VCF through our regional and local impact program that helped support the merger of the community and economic development of the Rutland region, which is the merger of the Chamber and the RDC in Rutland, was then leveraged by our pandemic response fund and its look at economic vitality with a larger grant to the Center on Rural Innovation, which is based in Springfield. The Center on Rural Innovation built 5 regional and community cohorts looking at digital economy ecosystem building across the state, including Rutland in that. That work, the cohort building in Rutland, then led to a larger EDA commitment a year and a half ago, Build to Scale program that is supporting the Rutland hub work around digital ecosystem building and then and economic development. That we're now in a position to complement with an allocation from the Vermont Mission Investment Pool into a place-based venture fund to help seed some of that new venture and activity. Similarly, the Northeast Kingdom region that was shepherded by the Corey and the digital ecosystem building, Due North co-working, partnership with Linden State College or Vermont State University's Linden campus, a number of other similar organizations up in the Northeast Kingdom just received an EDA $1.5 million commitment there. So there's just over a period of 4 to 5 years, there's just an incredible kind of place-based economic development, particularly in the digital ecosystem that the VCF has been a part of. If you're a donor advised fund holder, or if you're an organization with a nonprofit reserve or endowment fund, I think it's incredibly impactful to hold in mind the fact that when somebody gives to you and your organization for the purpose of your endowment or reserve, or you're having they're not just giving, and we're managing it, not just giving for the strength of that organization, but it's also invested in a way that is driving the vitality of the communities which surround your organization. You're part of a community of philanthropy that is building, that elevates, elevates communities and the experience across the state in some important ways. So many of the things that philanthropy is asked to solve for are downstream of the underlying economic and social conditions in place. And so it's really important for us as a mission-oriented manager of assets and partner to not just be investing to be grant making or making distributions, but also to be actively invested in those communities. And Lawrence has done a great job in the last year and a half, really helping organize that portfolio and build a strong structure around it and a theory of change around both the governance and the impact associated with it. So it's been good to have Lawrence aboard. Questions. I saw Charlie Kirker came off. Charlie also serves on the Vermont Investment Committee. So if you're off mute because you want to ask a question or make an observation, I welcome that. If there's anybody else who wants to ask a question, though.
Well, Dan, excuse me. I put the question in the chat, which is, I think it was last December, early December, where we had that gathering at Hula, and you were presenting basically to the world what was going on there and the role that the VCF with the new fund was, providing in support of the activities there, which were just exploding. And I'm wondering if, 9 months, 10 months later, you might just provide a little update on how that's been going, because there's just so much energy and so many young companies doing all kinds of innovative, interesting things. It was just a giant feast of sort of the work that Lawrence and you are doing around the state was really taking place there. Tremendous energy.
Sure. I'll do my best, and then Lawrence can correct what I get wrong. So for those who are not familiar, Hula in downtown Burlington is a redevelopment project of the old Blodgett Supply building. So when I first walked through that building 20 years ago in economic development, it was dark, hot metal stamping, plant manufacturing, commercial and industrial ovens on the waterfront in Burlington. Some local folks acquired the property and have redeveloped it and built an accelerator space that is world class. They also have a venture fund associated with it, but it's not an open venture fund. The VCF is the only limited partner in Hula's venture fund, and because they're doing it as a mechanism for community vitality and economic development. They invited place-based philanthropy to participate as their only limited partner. So for those of you with funds of the VCF, part of your 5% Vermont Mission allocation is actually allocated to the Hula Fund and invested in companies like Biocognitive, Upright Education. Lawrence, what are some of the other placements they've made that
Well, I think I'm not going to elaborate on the individual placements because I do lose track of what Hula is invested in and what VCF funded Hula is invested in. We are not in everything that the funded Hula is in. And we do also have some additional capacity in that it is essentially available as a sidecar if people want to make a donation to VCF to go into the funded Hula. We do have extra capacity in that. We're probably going to keep that capacity open through the middle of next year or so. So if people are interested in that one in particular, they're welcome to reach out.
So to elaborate, so a number of high growth ventures that are based at Hula that are scaling, some in the biotech space, others in the technology space. This is one of those investments that we expect to return in multiples to accommodate the pieces of our portfolio that don't. So we have $2 million of low interest debt with the Vermont Land Trust to support their farmland succession activity. So putting new farmers on conserved farms across the state. So we try to think about the portfolio in ways that complement each other. What Lawrence is describing is an option that we designed and we're talking about last fall at the event that Charlie was talking about, referred to, which is a way for people who wanted to allocate or participate in the Hula Venture Fund, the VCF at Hula Fund at a higher rate. We have a mechanism to allocate more into that space if people are interested in, because of the potential for higher returns and the connection to high growth innovation and technology-based economic development in Vermont. There are those, as Charlie, there are those for whom that is both a community objective and something that they're interested in seeing power their philanthropy over a longer period of time. So if there's anybody interested in participating at a higher level, feel free to pick up the phone and we can talk about how that works. Let's see, I rattled off a couple of the placements that they've made from the VCF at Hula Fund already. If you want a little more information, we can follow up and we can provide that. It's worth a walk through if anybody's up in Burlington and wants to see it, just because it's a pretty remarkable space in terms of the energy around tech-based economic development that it's generated. Other questions for us? If not, I just want to close with a quick note of gratitude, right? Everybody on the call has got a fund with the VCF as part of the community of philanthropy in Vermont, right? We spend all our time thinking about what it means for Vermont communities to be strong. One of the ways we think about that is the idea that Vermonters look out for one another. Whether it was the experience of the pandemic, the months after the pandemic, 4 years ago, 3 years ago, however long ago it was, or the experience of Vermont in the last 4 months since the floods in July, your participation in this organization, there's a nonprofit reserve and endowment fund as a fund holder, or another partner. It helps make possible our ability to be responsive in times of crisis. So it very much helps build an infrastructure that in the most recent circumstance then generated about $11.5 million of emergency response grant making to flood affected communities and flood affected families in Vermont. So by virtue of being willing to do this work together, with all that means under the umbrella of a place-based nonprofit like the VCF, you make that work possible. And that is a really important thing in terms of one of the things that we hold as the vision for Vermont as a place in which Vermonters look out for one another and neighbors look out for neighbors. And your participation in the VCF helps make that possible. So I just want to say thank you. So and I appreciate Mike's running through a performance of our portfolio. And I appreciate Lawrence giving a little more depth on the Vermont asset allocation, which is a really innovative and key piece of our work. But mostly I want to say thank you to everybody on the call for being a part of the VCF.